Welcome to Big Picture Earnings Analysis. Today we are breaking down Ulta Beauty's Q3 2025 results.
And what a set of results.
It just blew the roof off, reporting $5.14 EPS on nearly $2.9 billion in sales.
And they raised their full-year guidance for the second straight quarter. Let's unpack the strategic wins that drove that outperformance. And, maybe more importantly, what it cost them.
Okay, let's start with that financial scorecard because the sheer size of the beat is pretty credible.
It really is.
For the 13 weeks ending November 1st, they reported diluted earnings per share of $5.14. The forecast was only $4.52.
So we're talking about a positive surprise of almost 14%. That's a massive beat.
And all that profit was fueled by some serious top-line growth.
Absolutely. Net sales shot up 12.9% year over year to $2.86 billion. But the number that really tells the story, I think, is a comparable sales growth.
Which hit 6.3%.
Yeah, 6.3%. And you have to put that in context. In the same quarter last year, their comp growth was, what, 0.6%? So they just stepped on the gas?
That 6.3% is the key signal here. And when you look inside that number, you see exactly how they're winning. It was driven by two things.
A 3.8% increase in the average ticket and a 2.4% increase in transactions.
And that's a really healthy mix.
It's the best possible mix. It tells you two things at once. First, more shoppers are coming through the door, or their loyal customers are coming back more often.
Right, the transaction growth.
Exactly. And second, when they're in the store, they're spending more money, either buying more items or, more expensive items. It's real engagement, not just inflation.
So it's a perfect scenario for a retailer. But here's the paradox that I think confused a lot of people. Despite these incredible results, the stock initially dropped.
It did. It fell about 2%.
It recovered a bit in after hours, but that initial dip is really telling.
It is. When a company delivers a quarter this good and the stock still goes down, you know the market is worried about something else lurking in the report.
And in this case, it wasn't the revenue.
No, not at all. It was the cost of getting that revenue. This was a classic growth at all costs quarter, and the market reacted to the costs part.
And just to zoom out for a second, the 9-month picture looks just as strong. Net sales up almost 9% to $8.5 billion. EPS is up over 4%.
The trend is definitely there. But Q3 is where that trade-off, that tension between growth and short-term profit just became impossible to ignore.
Okay, so let's talk about that trade-off. Let's start with a bit of good news on the profitability side, growth margin.
Yeah, that was a positive surprise. It actually improved by 70 basis points, hitting 40.4% of sales.
So what was driving that strength?
Two main things, and they're both about operational excellence. First, higher merchandise margins. Second, and this is key, lower inventory shrink.
And for anyone listening, inventory shrink is just the industry term for product loss, right? Theft, damage, things like that.
Exactly. And Ulta is getting really good at controlling it. They mentioned specific things like new security fixtures, better training for their staff, process improvements.
And the fact that it was down across almost every category and region, that shows it's a real company-wide effort.
It really does. It's a huge structural positive for their long-term health.
It is, but that's where the good news on the profit line ends.
Right. Because once you move down to operating income, the story just flips.
Operating income as a percentage of sales actually went down a lot. It dropped to 10.8% from 12.6% last year.
And the villain here, the reason the market got nervous was SG&A. Selling, general, and administrative expenses, they just ballooned.
Up 23.3% year over year. So where did all that money go?
Well, I think you can break it down into three big investment buckets: people, performance, and platform.
Okay, let's start with people and performance. Why so much more spending on staff?
Two big reasons. First, higher incentive compensation. When you blow past your internal goals like Ulta did, you have to pay out bigger bonuses. That hits the income statement immediately.
That makes sense.
Yeah.
A good problem to have, I guess.
Yeah. And second, higher store payroll. They needed more people on the floor, working more hours to handle all that extra foot traffic. They're investing in the guest experience.
So they drove the demand, and then they had to spend to meet it. What about the third piece, the platform investment? That sounds more strategic.
Oh, it's critical. This is the amortization of their cloud-based software investments.
You're talking about their new digital capabilities like the marketplace and personalization tools.
Exactly. They're building a modern digital foundation. And because it's cloud software, the costs get spread out over time and hit SG&A. It's not a capital expenditure.
So it's a non-cash expense, but it directly reduces operating income.
Precisely. Ulta is consciously giving up some of that profit margin today to build a competitive moat for tomorrow. You can't compete with Amazon and Sephora with a dated website,
It's the cost of defending and growing their market share in a digital world.
and it shows you where their priorities are. It's a huge vote of confidence in their digital future, but yeah, it hurts the bottom line right now.
And that aggressive spending shows up on the balance sheet too. Short-term debt is way up.
Way up. It's at $551.7 million, up from around $200 million last year.
And what are they using that for?
Well, it's supporting working capital for those higher sales, but they're also using it to buy back a ton of stock, over $224 million in Q3 alone. They're telling the market they're willing to use leverage to both expand and reward shareholders.
So that spending, that SG&A surge, it all ties back to their Ulta Beauty Unleashed strategy. And we can see how those investments are paying off, starting with their loyalty program.
It's still the foundation of everything they do. Membership grew 4% year over year to a new record, 46.3 million members.
That is just a staggering number, and it's why all those digital investments matter so much.
And you see it working. E-commerce delivered double-digit comp growth. Sales were up in the mid-teen range.
What really stood out to me was the app engagement. The app now accounts for 65% of their online member sales. That's up from 63% just last quarter.
Their mobile investments are clearly working. They're pulling people into their most profitable channel.
Okay, so let's talk about products. Every category did well, but a few really stood out. What was the absolute powerhouse in Q3?
Fragrance. Without a doubt, it delivered double-digit comp growth.
And it seems like they nailed that high-low strategy perfectly. Luxury brands like Valentino on one end.
And then mass-market impulse buys like the Squishmallows collaboration on the other. That's Ulta's magic.
And you can tell they were gearing up for the holidays. They added more shelf space for fragrance in over half their U.S. stores back in October.
A clear sign of confidence. The second strongest category was skincare and wellness. High single-digit comps there.
What was driving that?
Prestige skincare was a big part of it, but also their big bet on K-beauty. Brands like Anua and Tertier are doing incredibly well. Plus, they had that huge exclusive launch with Fenty Skin Body.
And they're pushing deeper into wellness too, with brands like Therabody. And it feels like they're trying to become more of a broad lifestyle destination.
That's exactly what it is. It's a smart move. Wellness is high margin, and it gives them another reason for customers to visit.
And finally, makeup, their biggest category, still put up solid mid-single-digit growth.
It did. And you have to highlight their exclusive brand partnerships. They called out Beyoncé's Secret hair care line as the most successful prestige hair care launch in their history.
That's a huge statement.
It is. That kind of success makes Ulta the #1 destination for any major brand looking to launch.
Although we should note that hair care as a whole only saw mid-single-digit comps because styling tools were down.
Right. Tariff-related price increases hit that category, so the brand success had to overcome some pretty serious external headwinds.
Okay, so given all this outperformance, it's really no shock that they raised their full-year guidance for the second quarter in a row.
Not a shock at all, and the scale of the raise shows a ton of confidence.
So what's the new outlook for fiscal 2025?
They're now expecting net sales to hit around $12.3 billion. That's up from their old range, which topped out at $12.1 billion.
And the really big jump was in comparable sales guidance.
Yeah, a huge jump. They're now targeting 4.4% to 4.7%. The old range was 2.5% to 3.5%, so that's a whole different ballgame.
And that flows right to the bottom line. They're now guiding EPS to between $25.20 and $25.50.
A significant increase,
Mm-hmm.
but, and this is important, it came with a little bit of caution about Q4.
Right. They said they were happy with Black Friday and Cyber Monday, but they guided Q4 comp growth pretty conservatively.
They did, only 2.5% to 3.5%. Management said they're keeping macro backdrop mindfulness.
Which is corporate speak for.
For we know consumers are stretched thin. They expect shoppers to be focused on value, on deals, on affordable splurges. They can't just assume the strong sales will continue without a fight.
It's a smart, pragmatic view.
Yeah.
And beyond the U.S., Ulta is moving fast to scale new businesses around the world.
The international push is really aggressive. They closed the Space NK acquisition, which immediately gave them 84 stores in the UK and Ireland.
A ready-made footprint.
Exactly. At the same time, they opened 7 new stores in Mexico and their very first franchise store in the Middle East in Kuwait.
Using a franchise model in the Middle East seems like a savvy way to de-risk that entry.
It is. It limits their capital exposure while they learn the market. And then back home, the launch of the UB Marketplace is their big digital scaling effort.
This is the online platform that adds over 120 new brands, right?
Correct. It adds thousands of new products online. It's how they can expand into categories like luxury and high-end wellness without taking on all the inventory risk themselves. It makes their website a destination for basically everything in beauty.
And we should also mention there's a leadership change happening. A new CFO, Chris DeLorifus, is taking over right after this quarter.
A new hand on the tiller during a very high-investment, high-growth period.
So if we bring it all together, the core story here is one of exceptional execution that came with a very, very high price tag.
Ulta showed they can execute their Unleashed strategy perfectly. They grabbed a ton of market share, drove that incredible 6.3% comp.
But that growth came at the expense of short-term profit, which we saw in that huge 23% SG&A surge.
Exactly. The theme is this constant balancing act. They're making these massive, necessary investments in technology, in new platforms like the marketplace, in global growth, and weighing that against their margin goals.
And they chose growth.
They chose long-term market share over squeezing every last penny of profit out today, all while keeping a careful eye on a pretty nervous consumer heading into the holidays.
And that leads us to the final thought we want to leave you with. The company confirmed it's comfortable with its long-term operating margin target of 12% for fiscal 2026.
Even though they are on track to outperform that level this year.
So the question is, what will they do with those sustained margin gains?
Exactly. Given their stated commitment to keep investing heavily in the business, what new strategic initiatives will that extra profit fund next year? Do they double down on international? Or do they use that capital to accelerate their push toward their ultimate goal of 1,800 U.S. stores?
That balance between reinvestment and expansion is the key thing to watch. Thank you for joining us for this look at Ulta's record-setting high-cost quarter. We appreciate you listening.